If you're just starting out with investing, one of the first questions you'll face is, what should I actually invest in? Stocks, real estate, gold, or maybe cryptocurrencies? In this video, I'll give you a complete overview of the most important asset classes, their opportunities and risks, so you can understand how they work and what role they can play in your portfolio. Be sure to stay until the end to discover which mix can be especially useful for beginners. Before we dive directly into the individual types of investments, let's first clarify why there are different asset classes at all and why it's so important to know them. Imagine you put all your money into a single stock. If the company succeeds, you could make big profits, but if it fails, you might lose all your capital. That's exactly why in the financial world, we talk about diversification. It means spreading your money across different asset classes to cushion risks. And for that to work, we need to understand how each class differs. So let's go step by step through the most important options. Let's start with the most well-known asset class, stocks. When you buy a stock, you become a co-owner of a company. You benefit directly from its success, either through rising prices or dividends, meaning profit sharing. Stocks are fascinating because over the long term they have delivered the highest returns of all major asset classes. Looking at many decades, broad indices such as the S&P 500 in the US or the DAX in Germany have produced average annual returns between 6 and 8% after inflation. But of course, there are risks. Stock prices can fluctuate heavily. Within a few days, values can rise or fall depending on earnings reports, political events, or even just market sentiment. A good example, if you had bought Apple or Microsoft shares 20 years ago, your capital today would have multiplied many times over. At the same time, there are cases like Kodak or Nokia, once market leaders that almost completely faded into irrelevance. Stocks offer opportunities, but they also require patience and strong nerves. The second big asset class is bonds. A bond is basically a loan you grant to a government or a company. In return, you get regular interest payments and your capital back at the end of the term. Bonds are usually less volatile than stocks. They are therefore particularly suitable for bringing stability into a portfolio. The downside is that their returns are often significantly lower. Historically, safe government bonds in industrialized countries averaged between 2 and 4% per year, while corporate bonds were somewhat higher at 3 to 6%. Example: a German government bond is considered extremely safe, but pays almost no interest. Corporate bonds can give you higher returns, but are also riskier, since a company can go bankrupt. That's why people often say, bonds are the calming element in a portfolio. They don't make you huge profits, but they often smooth out stock fluctuations and provide predictable income. Now let's move on to real estate. Real estate has been one of the most popular forms of investment for centuries. Here we distinguish between direct investments, such as buying an apartment, a house, or a commercial property, and indirect investments such as funds or REITs, which allow you to get started with smaller amounts. The big advantage of real estate is that it's a tangible asset. You can touch it. Especially in times of high inflation, real estate is seen as a safe haven. In addition, it offers the possibility of generating regular rental income. But real estate is capital intensive. To buy an apartment, you usually need a lot of equity and a mortgage, and real estate is illiquid, meaning if you suddenly need money, you can't sell a property overnight. A good example: in recent years, housing prices in big cities like Berlin or Munich have risen sharply. Those who bought early experienced enormous value gains. At the same time, there are rural areas where prices stagnate or even decline. Real estate can be lucrative, but it depends heavily on location. Another major asset class is commodities. Gold is the most well-known here. Gold is considered a classic hedge against inflation and is often referred to as a safe haven in times of crisis. But silver, oil, copper, or agricultural products are also part of this class. The advantage of commodities: they are real assets. When money loses purchasing power, commodities usually retain their value. Gold, in particular, often rises when uncertainty dominates financial markets. But commodities also have disadvantages. They don't generate ongoing income, meaning no interest or dividends. In addition, they are very volatile because their prices depend on many factors: supply and demand, geopolitical developments, weather conditions, and much more. Example: during the 2008 financial crisis, the gold price rose sharply because investors were looking for safety. Oil, on the other hand, is extremely dependent on the world economy. In phases of weak demand, its price can fall drastically, as in 2020 during the COVID-19 pandemic. In addition to these classic categories, there are so-called alternative investments. These include hedge funds, private equity, but also newer developments like cryptocurrencies. Cryptocurrencies such as Bitcoin or Ethereum have made headlines in recent years. On the one hand, they offer huge return opportunities. On the other hand, they are extremely volatile. Prices can rise or fall by double-digit percentages within a few days. Example: Bitcoin has seen an incredible price development over the past 10 years. Early adopters multiplied their wealth. At the same time, there were always phases in which the price dropped by more than 70%. Alternative investments are therefore more suitable for risk-taking investors or as a small addition to a portfolio. They can be exciting, but they are definitely not a solid foundation to rely on alone. And finally, we must not forget cash and savings accounts. These also count as an asset class. Of course, cash hardly brings returns, and inflation even erodes its purchasing power. But it has a decisive advantage: it's immediately available. You can access it at any time, whether for unexpected expenses or to quickly take advantage of an opportunity in the markets. An emergency fund in a savings account is therefore indispensable. It ensures you don't have to sell your long-term investments at the worst possible moment, for example, when markets are down. And how to combine these asset classes? The real art now lies in building a portfolio out of these different building blocks that fits your personal goals. If you're more safety-oriented, you'll probably hold a larger share of bonds, real estate, or cash. If you're more risk-tolerant and want to grow your money in the long term, you'll rely more on stocks, perhaps complemented by small portions of commodities or cryptocurrencies. The important thing is, there is no single perfect solution for everyone. But the basic rule is, the broader you spread your wealth, the more robust your portfolio is against crises and fluctuations. Diversification is your best friend. As you can see, there are many different asset classes, each with strengths and weaknesses. The key is to find a mix that suits you, your goals, your time horizon, and your risk appetite. In the next video, we'll look at how to build your strategy and which ground rules you absolutely need to follow. So make sure to subscribe so you don't miss it.